Have you heard of this asset class called build to rent? Well, this is one of the most fastest growing asset classes. And the thing is, most people probably haven't even heard about it because it's still relatively new. Now, before we get into that, welcome back to our channel. I'm Dr. Jonny Walker. I'm an endodontist of 15 years, as well as a self-made multimillionaire in real estate investing. On this channel, we teach dentists and high net worth professionals on how they too can achieve financial freedom through passive investment in real estate. For those of you that know me, I'm also a fund manager, right? I help people to invest in vetted quality real estate investments. And those of you who have invested with us before know that we love multifamily real estate, right? We've invested predominantly in multifamily real estate up to this point. Now, there's a reason for it. There's a safety, it's a conservative investment, it gives a predictable cash flow, and it has the least volatility of all commercial real estate assets. But as we saw in the last couple of years, multifamily has had an unprecedented amount of distress and turmoil because of a lot of extraneous and economic factors that were very well out of the control of operators. This has led to some challenging times, especially if looking for deals that can pencil and cash flow. Now, we found that late in the multifamily cycle, there's still deals to be had, right? There's great distress in the market, but we're doing a great disservice if we're not looking at other asset classes, right? Every asset class has their own cyclicality. So different asset classes will have different levels of cyclicality. Now, build to rent, like as I mentioned, this is a prime time to start thinking about adding build to rent to your portfolio. And what we love to do on this channel is we don't try to be the expert at everything. Instead, we try to leverage other experts in the area so that we can fast track our success. In that same vein, I have an expert in the build to rent domain here today. His name is Mr. Ryan Watts. Now, Ryan Watts is the co-founder of Red River Development, which specializes in build to rent real estate investments. With a background in oil and gas, Ryan previously founded Springbok Energy Partners, overseeing over $200 million in royalty asset investments before selling the portfolio in early 2020. His real estate experiences dates back to college, where he began investing in rental properties. At Red River, Ryan focuses on land acquisition, deal structuring, and corporate strategy. Under his leadership, the company has grown to manage about 1,500 units with $400 million in assets across 5 build-to-rent communities. Ryan's expertise in investment, development, and capital formation drives Red River's growth in the emerging build-to-rent sector. Without further ado, let's bring in my guest today, Mr. Ryan Watt.
Hey, good morning, Johnny. Good to be with you.
Thanks for being here, Ryan. Thanks for taking time. I know you're super busy over there with Red River and all of the stuff, the great things that you guys are doing over there. So I'm not going to waste too much time. Let's get right into today's topic. This is for your knowledge, this is a channel for dentists. I'm a dentist. It's for us, by us. And we're looking to expand our knowledge in the world of private investment. And we're really looking forward to what you have to talk about in terms of build to rent. So first and foremost, for those of us that don't know what this is, what the heck is build to rent?
Yeah, hey, great question and a good place to start. So for us, we're developing what we call cottage style or horizontal multifamily style communities. So we've got about 10, 11 homes to the acre. And what we're really trying to do is give our residents, and we built a BTR brand called Trow Homes. So if you Google Trow Homes, you'll find all of our communities there, in addition to, on our website at redriverdevelopment.com. But we want to give our Trow residents the best of both worlds between a suburban rental home and a Class A multifamily community, right? So we have the amenities of a Class A multifamily community. We have, a large clubhouse. We've got a resort style pool. We've got a high-end 24-hour fitness center. We've got, community spaces that our residents can rent. We've got, dog parks, green spaces, all of those things, playgrounds, bocce ball, those sorts of amenities. We have on-site leasing. We have on-site maintenance that handles all maintenance on the property. But, like a home, we want to give our residents something that feels like a home. And so, they're parking either in surface parking or covered parking or garage parking for rent. And then they're getting out of their vehicle and they're walking to their front door. So these are unattached homes. They're all single story. And each one has its own private backyard. So it really does give the best of both worlds between that suburban rental home and, the amenities of a great Class A multifamily community.
So so now a build to rent community, it's almost now all the things that you mentioned, right? A lot of these amenities, dog parks, green space, barbecue areas. These are all amenities that are in multifamily, in a larger multifamily apartment build community as well, right? So it seems like there's a lot of similarities with the build to rent. Now, even when you say build to rent community, like what does that look like conceptually, right? Like I'm just trying to figure it out you said it's, so you cluster a bunch of houses together in an area. Like what exactly does a build-to-rent community look like?
Sure. You know what? Let me share some pictures,
Sure.
and I think that'll help give a little bit more color to it. This is an aerial view of our Trow Homes community in Kansas City. It's called Trow Homes Twin Creeks. It's in the north, as they call it, the Northlands or northern Kansas City, about 20 minutes north of downtown KC. So this community happens to be 220 homes, 1, 2, and 3 bedroom homes. And you can, I don't know if you can see my cursor here, but the clubhouse is there, and then you can kind of see the homes that are built in 4-pack clusters essentially, scattered throughout.
Now, all of the houses in this picture are part of this one build-to-rent community, correct?
Yeah, this is a single build-to-rent community. Exactly. Yeah, and all of these homes are for rent. So, and then in terms of some other imagery on the amenity set, these are the amenities that we're offering. And I touched on them earlier, but just to give you some imagery and a feel for it. And then as you look here, this is really a look at what the homes look like, both exterior and interior. You can see the private backyard, and very high ceilings, 10-foot ceilings on these homes. So it really does live like a home for our residents with Trow. And then a few more pictures here of our amenities. So hopefully that gives you a good, you and your audience a better feel for what that really looks like.
Sure. So it almost looks like you have 200, that picture was crazy, right? They had 230 small houses, basically. Well, I don't know if they're small, but they're 230 houses in one area. And then you showed one large building. That's where a lot of the amenities and all the community, common area stuff is, right? And
that's
I'm
right.
assuming that's also where the leasing office is as well.
Yeah, that's correct. That's where we have our on-site leasing folks. They're headquartered there. And so that, that really drives lease up. The way we build this, we build it in phases. And our first phase is always the main community center, and then a model home, and then we'll usually get 15 or 20 homes as well in that first phase. And so that's what we'll do pre-leasing before, but having that amenity center there and having the on-site leasing team there, that's what really jumpstarts the lease up.
So it almost seems like this is like a multifamily building, right? Except instead of instead of just building like one large building, or maybe even just having a bunch of maybe 7, 8 buildings clustered in one area. This is like, hey, look, this functions as a large multifamily real estate property essentially, right? Except instead of units, it's individual houses basically. Would that be a fair?
That's a great way to think about it. I think you're exactly right. Yeah. And again, we're trying to give them the best of both worlds, right? So the problems that you have in a multifamily community that people get tired of is, hey, I've got people above me, below me, I'm hearing, noises all the time. I'm smelling other people's dinner. Maybe I have a dog, maybe you're starting a family, so there's a lot of folks that kind of maybe start in a multifamily, community, but are tired of some of the downsides of multifamily community. And so this for them is a great in-between space where maybe they're not ready to buy a house yet, or maybe they own, they owned a house and they sold it and they really don't want to own a home anymore. This gives them, some of the best of both worlds between, that suburban rental home and the Class A amenities of an apartment community.
Because you mentioned, hey, we got 1, 2, 3 bedroom houses, and then you also made the point of saying they're single story, and I think, and I'm gathering that, hey, look, you won't have anybody living above you, right? Like that. This is a house. It's basically like a little house here, right? It's
That's
not
right.
Like you even have a backyard. You can go and sit in. There's a front. You can park. It really feels like you're living in a house, right?
That's exactly right.
Farm building. Yeah. So it seems like, just from a bird's eye view, it looks like the quality of living in these communities would be higher than in an apartment building. This is just my own 2 cents, but
look, I think that's right. And we really see 2 big demographics show up here. I mentioned earlier the people that are transitioning out of apartments. They're not ready to buy a house. Those are kind of what we call our young professional segment. That's our biggest segment. But then also on the other end,
young families, would you say, Ryan? Like with kids? Like what does what does a typical tenant look like?
Sometimes, yeah. No, I think the young professionals, sometimes they're starting families too, and that can certainly be the case. And then on the other end, I think we see a lot of empty nesters, folks that maybe raised a family in a suburban community. They're older, but not, they're not old enough for senior living. They're still very active and moving around, and maybe they want to be close to the grandkids, close to their kids. And so this is a great option for them because, look, there's no maintenance. They don't have to deal with, any of the headaches of home ownership. They're efficient sized units. We're, 3 bedroom homes, 1,200 square feet. Two bedrooms about 1,000, and the one bedroom's about 750. And so we've really seen the empty nester demographic show up big in our communities, probably even in a bigger way than we expected. And then you've got all manner of folks in between. We're in high-end suburban locations. We do look at school systems. We want great school systems. So yeah, for those families with kids that want to access the school system, that's a great option too.
So that kind of led me right. You kind of led me right into what my next question was, right? Like, so what is the rent, right, compared to a traditional multifamily real estate, right? Like, if you're in an apartment building and a 2-bedroom, would you build to rent? With the rent, I would imagine because it looks a lot nicer, it looks a lot better. What would the rent? Is it comparably? Is it much higher? Is it higher? Is it the same? Like, why would somebody pick?
Yeah, we definitely see premiums. So it's a premium product in the sense that we're usually going to be priced 20, and sometimes even up to 40% higher than new build Class A multifamily communities on a price per foot basis. So,
and this is comparing Class A multifamily and a Class A, like,
a BTR community. Yes, that's right. That's right. So on average, our rents are around $2,000 a month, give or take, sometimes a little more depending on the market. But we're usually around $2 a foot, give or take. And, but if you look at that and compared to, the cost of home ownership, I mean, the median priced home in the United States right now, your mortgage, just principal and interest, is getting pretty close to $3,000 a month. Yep. And then, that's not even to mention, maintenance costs and, insurance costs and all the other things that come along with home ownership. So, it's really a great value, for our residents.
Yeah. So now the other thing I was going to ask is affordability, right? Like, so obviously and I'm glad you mentioned that it's more affordable than going and buying a house, right? Like I think I read a recent article with interest rates where they are. I mean, there's only, I don't want to say the number, but there's the number of people that can afford a $500,000 house. Your median income needs to be like $150,000 or something like that, right? Whereas the median household income in America is probably about half of that. So the affordability is definitely out of the place. So now, what type of tenants can afford this rent? It's still, even though it's cheaper than home ownership, but relatively speaking, it's still pretty high rent. So I'm assuming you have to pick certain demographic or area, there's certain median income, I would assume, that can support these type of rents.
Yeah, no, that's right. That's a good question. Yeah, we do want to be in areas where we see high median income. That's, when we think about our investment criteria and the demographics that we want to see at a site, we want to see those, high, call it 80 to 100,000 in median income. That's kind of generally the range that we're finding that performs the best. And so, median incomes is an important one to think about.
So AMI, okay. Now we've kind of talked about this. We talked about this asset class, what it is, what are the advantages of it. Before we leave this, are there? You kind of pointed out the advantages over multifamily, right? Mm-hmm. Are there disadvantages of build to rent compared to multifamily?
I think it's a different product type, but I think it's one that is growing fast, right? Because there's not a lot of space between that traditional suburban rental home and a suburban garden style apartment complex. And so I think, as I'm sure you and your listeners are aware, we got a big housing shortage in the United States. There's not enough housing. And this is a great product that gives people, that can be built a little bit more quickly, right? And when you're building a home of 250 homes all at once, it's a great solution for folks that want another housing option. And we've seen that. We've seen the demand for this be really strong because it's a newer product type, and it's something that residents haven't experienced before, but they love it because it gives them the best of both worlds between that multifamily community and a suburban rental home. So that's what we've seen. Obviously we're building this from the ground up, right? We're not, this is new construction. And there's a lot of benefits to that, certainly, but it does take a little bit of time to construct. But we think at the end of the day, we're delivering a great product to our residents and the markets that we're focused in.
All right, so I think this is a good transition, based on what you just said there. Now let's talk about this. Let's put on our investor hat, right? Now we kind of understand what this asset class is. We know that it's a new thing. Now, as an investor, why would a dentist, doctor, why would a doctor consider an investment in a build-to-rent asset class?
Yeah, that's a great question. Well, I would say first and foremost, just because we can deliver really strong returns. I think with this product type, we're seeing IRRs in the mid to low 20s, and cash on or multiple on invested cash flow or invested cash investment is usually around close to 2x. And so but I think that's the primary reason. And then look, another key difference between a traditional multifamily community is, our tenants and our residents typically stay about twice as long as they do in a multifamily community, and we're able to push and grow rents in a greater way than traditional multifamily community. We're seeing on our community in Oklahoma, which is the first one that we stabilized, we've seen 8 to 10% increases in rent, just because the demand is there, the product's unique, it's differentiated, and people want to want to live there.
You say 8 to 10% rent increase. This is like in 2023, 2024.
That's right. Yeah, and I think part of that's
incredible.
Yeah, no, absolutely. And I think part of that is the fact that we've also been a first mover or a fast mover in strong secondary markets where there's not as much competition. We're not in markets like Austin and Dallas and Phoenix. You've just seen so much construction happen, so much new construction. There's a lot of downward pressure on rents, right? And you're seeing rents go down. A lot of those markets.
Rents have gone down significant. Yeah. All those markets you mentioned, yes.
Yeah, and so markets that like we're in Tulsa, Oklahoma, and Oklahoma City, and Kansas City, and Indianapolis, and Bentonville, Arkansas. We're still seeing strong rent growth in those markets. Now it's not some of the crazy double-digit rent growth that you had for a time in Phoenix, but it's good, strong, steady growth. 3%. Something like that, which is, we really love those markets.
I mean, so it's true now. So now we've invested in Dallas. We've invested all those places you mentioned. We've actually invested in a lot of these, primary markets. Obviously, there's reasons for great primary markets because there's the strong macroeconomic factors. But it also leads to these type of things, right? We had a record level of apartment units come online in 2023. I mean, over 1 million units came online, which was the fastest growth of housing, I think, in 40 or 50 years. So unprecedented. A lot of historical precedents we've had in the last few years, right? We had a global pandemic, we had global shutdowns, we had interest rates that were near zero, and then we had 450 basis. We had the fastest rent increase in history. We had inflation that was never seen in this country for 40 years. We had in the last 5 years, we've had a lot of tumultuous times, right?
No doubt.
When it's come down, it led to rents going way up 20% in 1 year in those primary markets. And now we're seeing a pullback, right? Because now there's an overdevelopment. We've had overdevelopment. I wouldn't say overdevelopment because we still have a scarcity of units. But because of the rate that these units came online so fast, it started putting downward pressure on rents. But new construction has also stopped in the 2020. New starts of new construction has stopped in 2023 and 2024. So we should see that sort of work itself out. But now you're in secondary markets where you didn't see that abundance of development, right?
Yes.
So I guess that's helped in a way because in places like Phoenix and Houston and Dallas and Charlotte, it's like, hey, let's build, and people pump tons of money into these primary markets. Secondary markets are slower to that party, and that's been advantageous in that, hey, look, rents didn't spike as fast as maybe in primary markets, but also we're not seeing that big pullback, and rents aren't declining while this new supply works itself through the system. Eventually, we're going to start to see stuff even out, and the lack of development now in 3 to 5 years will again lead back to the scarcity, and hopefully we get some organic rent growth. But now in the secondary market, it's while everybody else is going down, right? In Houston, rents are down 2%. In Phoenix, rents went down 3%, right? In Dallas, rents went down 1.5%. Now you're talking, and this is an environment with high interest rates, and you're talking about, hey, look, we had 8 to 10% growth. I don't think that we should sweep that statistics under the rug because it's significant, right? Yeah. So even in a down market, this is very much a down market, we're seeing rent increases. Which is incredible. So I'm pretty blown away by that. But now you're saying that on an average, you're saying about 3% rent increase. Is that what you said, or is that?
Well, I was really referring to, as an example, like the Kansas City market. If you just look at the whole market, year over year, Kansas City's rents are up about 3%. Our specific, that's not our specific communities. Like I said, in our stabilized community, we've been able to grow them, in the 8 to 10% range. So, I think it's a function of what you touched on earlier, which is, look, these markets were underinvested to start. There was not as much capital coming in there and really building. And then furthermore, with the run up in interest rates, the change in the capital environment, that new construction is not happening there in great demand or a great supply either. Like there's not a lot of building happening in these markets either, in the same way that there's not a lot of new development happening even in the primary markets because of the change in interest rates and sort of the change in the capital environment. So yeah, we still think these markets are great places to invest. They're still undersupplied. There's not a big supply pipeline coming on there, and we've seen our built-to-rent communities really perform well, where we're delivering a differentiated product to these markets.
So how do you decide on a market, right? How do you decide where you're going? So you mentioned Oklahoma, you're in Kansas City. What is your sort of criterion for selecting? Where are you located, and what's your criterion for selecting markets?
Yeah. I'm based in Dallas. So Red River, we formed the company in 2020. We're headquartered in Dallas. So in Dallas, I sit here along with my partner, Jay Dempsey. And then we got our finance team, accounting team, capital markets, deal team is really based here. And then in Tulsa, Oklahoma, my brother, Steven, who is also my partner, Steven Watts, he sits in our Tulsa office, and he really oversees construction, development, project management, and then our property management business, which is Trow Homes, the communities I mentioned earlier. So that's our property management team is kind of headquartered there, other than the folks that are on site, right, at our individual communities. Is kind of how we're set up. So, we overall are looking for strong markets in business-friendly states. We've been, like I said, a fast mover in what we think are strong secondary markets. So we love Tulsa, Oklahoma City, Kansas City, Indianapolis, Bentonville, Arkansas. Those are good markets, and they're regional to us, right? If you think about Dallas and Tulsa, like those are all within a short drive. With the exception of Indianapolis, which is we have a development partner that's based in Indy who builds for us up there. So we're 50-50 with those guys. So that gives us good regional coverage in that upper Midwest area. So yeah, if you think about like a market like Indianapolis or Kansas City, these are business-friendly states. They're lower tax states. In the same way that you saw the exodus from the coasts, if you will, during post-COVID, right? People coming, and this is still happening today in Dallas, right? Where you got people coming from the West Coast, you get people coming from the East Coast, people piling out of Chicago. Dallas and Phoenix and Austin grabbed the headlines, but they're still going. They're going to Kansas City too, and they're going to Indianapolis too. That's Indianapolis is 2 hours from Chicago. You get a lot of people going down there, and so they're still experiencing some of those same trends. And it's not the white hot growth, but it's still strong, steady growth, and that's kind of why we love those markets. And then as you get beyond, thinking about, okay, pick a market like Indy or pick a market like Kansas City, which we really like, we're going to hone in, and I'll share my screen just to give you some color on this, but we're going to hone in and really look at some key demographic factors when we think about site selection, and over on the right on this slide, I know this is a lot of numbers, but on the right, you'll see kind of the national benchmarks, national averages for these stats. So, household growth, income growth, household occupancy, median incomes, we touched on that earlier. That's important, rent to income ratio, and then home values. These are some of the key demographic factors we look at, and so we want to see numbers that are even with or even outpacing, ideally outpacing the national benchmark. And so that's when we really hone in and look at a site and think about site selection. We want to be in these strong suburban submarkets that have strong incomes, strong household growth, strong income growth, all of those things. So those are when we think about, hey, where do we want to invest? We look at it through that lens.
Yeah, so it looks like there's a lot of similar criteria that we look for in multifamily, right? Like we're looking for population growth, we're looking for job growth, we're looking for median income growth. And all of these things are very similar, right? So and it makes sense because this is housing. We're looking for people, and can they afford it? And the other thing, key factor that you mentioned is business friendly. I don't think that can be underestimated. That can't be underestimated, because as a guy that's invested in New York City before, I know the problems with being in a tenant-friendly state, right? Tenants can literally live for. I know one tenant that's been living for a year and a half not paying rent, right? And I don't know how, but for some reason, there's ways that judges don't kick. For some reason, and tenants, people that know these laws, they take full advantage of them. The tenancy laws, and all of a sudden you're stuck in a headache. You're non-paying rent, and then you have a list of hardworking people that are looking for a place to live, and they can't find it because you have some joker that's taking advantage of the system, right? So being in a business-friendly state, I think, is very, very important to a very important nuance that you mentioned. Now, sort of landing the plane here. Why is it that you can go and develop these communities, whereas apartment building, multifamily guys are like, hey, look, it's too expensive. What's different? Like, well, that's kind of a question that's on my mind. Like, hey, look, it's too expensive for all these developers, but it's not too busy multifamily developers, but it's not too busy for us. Well, can you maybe put some color on that?
Yeah, sure. I think because build to rent is a new asset class, right? A newer asset class. And you really can't, you touched on it earlier about the idea of distress in the multifamily space, right? All the capital right now in multifamily is looking for distressed opportunities. They want to say, hey, where can I go buy below replacement cost, right? That's the focus now in this environment. We're deals that are in trouble, that maybe got over levered, and we can try to buy them on the cheap today.
Yes.
Well, you can't do that in build to rent, right? Because this is a new product. Like that's the stuff that has gotten built is not distressed. It's performing great. And so but there's not enough of it, right? It's just, we're in the very early innings of build to rent. And so to really go satisfy demand for this product type, you got to go build it. And so that's the key, one of the key differences, I think, between, traditional multifamily, which has been, built heavily in a lot of markets, and why it's generally not in favor today, to construct new garden style multi. But build to rent is different because of some of the things we touched on earlier, the unique product type, the premiums that you get over Class A multifamily, the rent growth that you're seeing, the stickiness of the tenants. All of those things are very different than traditional multifamily.
Excellent. So I mean, it seems like this is a really exciting asset class. I mean, especially from an investor standpoint, obviously anything that is doing this well is obviously exciting. And it's exciting because this product type, like you mentioned, this is serving a significant need that previously hasn't been addressed, really, right? Not in a mass production, institutional way. There's never been an approach to this. This is also a way to build affordable housing. I say that in air quotes because it's still affordable. It's more affordable than buying, and it gives people an option, right, that are priced out of buying a home. And one of the big problems they say is, hey, look, there's affordable housing problem. There's not only just a scarcity of housing, but scarcity of affordable housing is even more dire in this country, right?
Yes.
And it's like, hey, look, this is a way that we can address this issue. This for people that are in the higher income earning of the affordable housing segment. I believe this is a great answer to that. Number one. So this is a way that we can increase supply in an area that is greatly lacking, because otherwise we're depending on Class A development, and then the A's that have gotten 15, 20, 25 years old, they're starting to become B properties now, and then now this enters into the affordable housing section. But here it's like, this is a way that I don't have to buy brand new house, but now I can still get a beautiful place to live, and it's got all these great amenities. So I can see why there's such a big demand for this asset class. It seems like an exciting asset class. I'm definitely excited to learn more about investing in these type of things, and as I'm sure a lot of the listeners here are. I know that you currently you have a deal that I've heard through the grapevine that you guys have potentially a deal coming up soon, and our fund is going to be taking a very close look at that as well. Is there anything else that you'd like to add before we kind of sign off here today?
Yeah, no, I appreciate it, Johnny. Thank you. Yeah, I think one thing that we didn't touch on that might be helpful for your listeners is just to talk about the investment overall in terms of how does it flow from a cash flow standpoint, right? Yeah. And I'll share my screen real quick to give some color to that. So what, we're building this from the ground up. I mentioned we build it in phases. So one of the things that's really unique and different than multifamily is that by about month 14 here, we're going to start moving residents in, right? We get the clubhouse, we get the model home, we get the first 20 homes. All of a sudden, we've got income coming in the door here. And then we're going to continue to build that and construct it until we get about month 23, when we would be done with construction. And from there, we're looking to have that leased up in call it 6 to 8 months. So around month 30, we would expect to be stabilized. And at that point, we're going to make distributions to our investors, right? So at that, we would expect them to get high single digit to low double digit cash on cash yields in and around that month 30 timeframe. And then the business plan here is to continue to grow NOI, to continue to push rents, and operate the property. And then we would look to exit at the end of year 5. And that's, when we think about how do we generate that kind of mid to low 20s IRR and 2x multiple, that's how we do it, is kind of in that time frame. And so this gives you a good kind of overall look at the deal, the capital stack for an investment opportunity. And yes, as you mentioned, we do expect to be launching a new development opportunity here in the next 30 to 60 days. And so, but I think it's important color just to share with the listeners kind of how does it come from day one of that investment, and then what the business plan is ultimately that generates the return.
Yeah, I'm glad you brought that up. I actually forgot to ask you about the investment metrics. So one thing that's different, the departure, is that when you're buying an existing property, you might get cash flow, depending on the amount of time it takes to renovate units and stabilize units, depending on the level and the amount of facelift that you need on a value add apartment building, where your cash flows could start anywhere from 0 to 12 months. Whereas in a development project, because you're building a brand new product, it takes some time to actually build it. and start renting it up. But one thing is, like, whereas an apartment building, you build one large structure, that whole building needs to be completed before you start moving tenants in.
That's right.
It's like, hey, look, let's build this leasing center with the beautiful amenities and community center, and then we're going to build a model home, and then build the first 20 houses, and then start leasing those up. Before we don't have to wait till all the units are built before you start leasing, right? So now you start leasing those units while we're concurrently building more units. So I think that starts to decrease the amount of risk because you start bringing in income. Now, you said cash flows don't start until about month 30. So we're looking at about 2.5 years where you put, and that's another thing for an investor to consider. You have to have a long-term mindset. I know we talk about cash flow on this channel a lot, but in the first 2.5 years, you might not have any cash flow, right? And that's because this is a build up. We're building this thing up. But now after this starts to build up and it starts to get leased up, Ryan, what's the cash on cash look like? I mean, is it a significant cash flow? Is it something that, hey, look, we've been waiting for all this time, and now the trade-off is that, hey, look, we're going to start to get some really high cash flows? Or we're more looking for, hey, we got this excellent level return. We got a mid-20s IRR, which beats the treasury at 4.5%, right? So, let's talk about that, the cash flow a little bit. How much cash flow, or is it more of a, hey, look, let's hold and then we get a bigger chunk of cash deal that's sold after 5 years?
Good question. Yeah, we want to generate strong yields for the investor once we get the project stabilized, fully leased up. We may also refinance out of our construction debt. We may find that we can put some fixed rate financing on that maybe gives us a little bit greater cash flow, which is something that we did in our stabilized community in Tulsa. And then, the yields should be, high single digit to low double digit yields. So strong cash on cash yields coming in, around month 30 or so. And then looking to continue to grow and grow NOI and optimize value and look to harvest the investment, at the end of that 5-year period.
So that 5-year period, that plan is to sell this community, right? You build this.
Yeah, that's the base business plan. Yeah.
Awesome. Very good. Yeah, I don't have any further questions. This was a very enlightening discussion. I'm really glad that you stopped by and talk with our listeners about this. If somebody wants to learn more about you and what you're doing, I mean, what's the best way to reach out to you?
Yeah, you can find us online, redriverdevelopment.com. We actually just redid our website, so you can connect with us through that. It's probably the easiest way.
Awesome. Very good. And we have yet to see this deal. We've yet to do due diligence on this deal yet. But if this deal does go through our stringent filters, and we're obviously going to run Ryan and his whole company through the ringer, because that's the way we do due diligence. And if we come out of the other side of due diligence and we feel like, hey, look, this is a great deal, we feel very strongly about this investment and about this operator, then this investment will also be available in our fund. So for those of our investors, you go to walkofwealth.com to learn more about joining our fund and getting onto our portal. You can create a free account on our portal, and that's where all of our investments will be, including hopefully a build to rent community in the next few weeks as well. All right, Ryan, it's been an absolute pleasure having you here, and we'll probably have you back again at some point. But for everyone else, thank you for being here today. We'll be back again next week with another video to keep the bank accounts growing and the cash flow flowing. All right, guys, see you next time. I'm Dr. Jonny and Mr. Ryan Watts.
Thanks, Jonny.